Hey everybody, Ben Nelson, the everyday real estate investor here. Hope you're having a fantastic day whenever you're listening to this. Thanks for tuning in to another episode of the podcast. I hope you've enjoyed the guests that have been able to join us over the last few episodes. I know I have, and feel very privileged to be able to have some of their very valuable time. I know they're all very busy people doing a lot of big things, and just have a lot going on. So I appreciate them taking some of their time to be on the show, share from their knowledge and experience, so that other people can learn and benefit from those things, and also continue to learn things and maybe see some new opportunities, and maybe even have the ability to connect with somebody listening to this. There's been several people that they raise capital, they're involved with partners, that sort of thing. And so always hope that there's the opportunity to connect people in that way as well. So um, yeah, we're definitely looking forward to having quite a few more on moving forward. But today we're going to jump back. It's just me. I'm sorry. So got to jump back to a little bit of stuff to throw out some of my own kind of thoughts. I love the interviews. Definitely going to keep mixing those in, but just kind of like throwing out some of my thoughts as well. And I am actually going to stay, uh, real estate investing, uh, nuances focused today. You know me, I tend to go when it's me just on the microphone. I get philosophical a lot of times, and so definitely will be doing that because I just can't help it, and just life provides plenty of opportunities to do that and to sit back and kind of learn and you know just kind of think on some things more deeply and make sure that we're um, learning and growing and finding those opportunities to learn those lessons and be better, and just make sure we have good direction in our life. So but again, today we are not going there. Today we are going very much deal and real estate investing specific, and we are going to talk today about investment due diligence, and things to look at when you are looking at a deal, things to do when you're doing, a deal, when you're looking to put something under contract, or you have something under contract, or even before you get to that point when you're just kind of first underwriting a deal. And so this just up front, this is far from everything that you want to look at when you are looking at a deal. Um, Obviously, some deals are going to have a lot more to them than than others. If you're looking at a single family home uh, in a development that's fairly new-ish, but it seems to be a good deal, that's going to be very different from your older neighborhood with maybe a larger lot, has a lot of rehab to do, maybe some opportunity to do a partition, and then obviously that's very different from anything multifamily or commercial. And development, you throw all the different types of real estate that we can be looking at depending on what your niche is and what you're looking at the time. The list is going to be very different, but this will give us a starting point. This will get hopefully the wheels turning, maybe some things in here that you haven't done on deals in the past, if you have done some deals, and you've gotten lucky or maybe you've learned the hard way, but maybe you just didn't think about it and you were fortunate to not have it come up be an issue. But we're going to dive into some of these things just to make sure that you're not missing things, and maybe adding some things to your due diligence checklist to make sure that you are checking the things out that you need to. So I'm just going to go dive into this. Hopefully you're taking some notes here as you're listening. And again, this is far from a full list. Uh, there's a lot more to it, again, depending on how detailed your deal is. But let's jump into it here. First thing, your very basic element of due diligence, your general inspections. So you are going to be wanting to hire an inspector. Now, I have bought properties without getting an inspection, but you know, There's things that, they're either really simple deals, they make sense, I'm willing to take that risk if of something bigger coming up. And I've done everything, I've done kind of the whole spectrum of I've done bought properties with no inspection, I've bought properties with full inspections, I've bought properties where it's like, I think I see what's going on here, but I really don't know what I'm looking at for the foundation, and this is an older property, and so I want someone to come check it out, and I'll just have someone just look at that aspect of it. So, um, kind of depending on your experience, your comfort level, you may opt not to do a home inspection. Now, um, I always advise people I'm working with as clients to get inspections because you want to know what's going on, and there's so many hidden things um, that you may not know about that an inspection can reveal. So I always advise it. But again, if you're getting a good enough deal, maybe you just take that risk and you just factor that in. You've got it for a good enough price. There's enough upside. You have enough contingency built in that that really you can handle anything, worst case scenario, and still come out okay. But that's going to be one of your main things that you're going to want to look at is your general inspection. Get a professional in there, a generalist that's going to look at every aspect of the property, tell you what they see, tell you what might be going on that you can't see just from first glance. Um, and the and from there, that's going to open up some other things that you are going to want, that you potentially want to check out. So you might have um, a specialist that you need to bring in. I mentioned foundations earlier, right? Um, you may have want a roofer to come out and assess something closer. You may want to do a sewer scope, check out the sewer line, have an electrician come in and look at things closer. So there's, a general inspector is going to be able to give you. They're not a specialist, right? You go to your general practitioner doctor. They're going to get, they know lots of things, a little bit about a lot of things, right? But if you have a problem with a specific part of your body, if you have a heart condition, if you have something going on with your lungs, you're not going to just, continue going to your generalist. You're going to get referred to a specialist, right? So same thing here, where you are now going from your generalist, they found something that, hey, I think something's going on here. Now you bring in your specialist, you have them take a closer look, and they're going to have a lot better idea of what it's going to take to resolve that issue. So here you're assessing your overall condition. You've probably already made an offer at this point, right, based on what you see and what you do know. Now you can dig in and find out what you didn't see and what you didn't know about, and then make sure that you're still able to make a deal work. Start putting some numbers together, and that's another part of this step, is bringing in maybe some contractors that can do the work. A lot of times sometimes it's going to be the same person. Maybe it's for some of those specialized people. You're bringing in a roofer, right? They're assessing the roof, but they can also give you a price to repair or replace it, right? And getting some actual hard numbers, some hard bids together, so you're not guessing, right? We don't want to be throwing numbers out, to that we're not verifying, right? We're just ballparking, and I think this is what it's going to. Especially prices have been changing so quickly. You really could very very easily, if you haven't done a remodel in a while, be underbidding, if you're just kind of tossing numbers out. For my last project, it was around this. Don't do that, right? You may do that on a few line items. You're not going to necessarily go price every single thing out, but especially the big items, get some numbers on it and know what you're getting into. Part of this process too is you're going to want to check permitting. Was anything done with a remodel? And depending on if maybe a bunch of work was done and they didn't get permits. Now, okay, what does that look like? Do you have to go back and get permits after the fact, or are you going to be okay, moving forward, just with new permits for the work that you're going to do? Was work done and permits were not completed? We had this on a listing recently, where permits were taken out, like 15 years ago. One piece was not completed. It wasn't even really a big deal. They just didn't do it, and so all the permits expired. Even ones that were not connected to the work that was not completed, like all of them were just expired and not signed off on. And so they had to go through that process. And fortunately, the county was able to work with them, and willing to work with them. And they went and they did the part that was not completed, and they signed off on and finalized those permits. But that's something to know, right? Is something done unpermitted? Is something expired with a permit? And what does it take to go and finish those permits if something is in that status? So making sure to check permits, um, checking the title. The title, we've got one right now. We're working with the client where there's a few things that are things that I've not seen before on a title. Now, I'm not a title expert and I'm not a title attorney, but I always look them over just to see, what's on there. You're going to see your homeowner association CCNRs. You're going to see a few different things on there, but there were some exceptions on the title report, that it's like, what is this? I don't really know what this is. So you may want to get some advice from a title attorney to have those things checked out. Make sure it's not something that's going to limit you in a way that you don't expect, right? On that note, within that could be CCNRs. It could be, those covenants, conditions, restrictions. You see this uh, a lot of times on view properties. I've seen this on a few recently where it's a buildable lot, but where you can build is and how and what you can build and how high you can build, and all of those things are very specific because they don't want you to block the view of other lots. So it is restricted for the benefit of the surrounding lots, so you're not blocking the view of the mountains, things like that. So you have to check that stuff. Make sure that if you're planning on doing something like that, you need to know, are there restrictions, and what are those restrictions on what you can or can't build. Location, heights, all those things. um, Definitely want to check those out. Zoning itself. Now, not every part of the country, not every jurisdiction has zoning, but many do. We definitely have zoning here in Oregon, and in I think all of our local jurisdictions. I'm not aware of any that don't. And it's a limitation on what you can do, right? So you need to check and make sure what you want to do, you can do with the zoning. Not only that, you want to check, okay, what is built there and is it conforming? Is it conforming to the current zoning? Because if it's not, what happens if the property burns down, right? Are you going to be able to put that back? Now that may or may not be a big deal. Maybe you don't want that there. Maybe it would actually work out better in that scenario, right? But if you're buying something that's a fourplex in a single family zoning, and you're buying it based on the fourplex income, but you could only build a single family home there. If it burns down, you're losing a lot of income, right? You're probably going to lose a lot of value, and so you need to know that and assess that risk going into that. On the flip side of that, is there a possibility of expanding? Is it a single family home now and you can add something? I've talked about one of my deals I did here in Newburgh, where people uh, drove by more times than I can remember while I was building an accessory dwelling unit on the lot, and people that had passed on the deal, and they're like, I didn't realize that you could do that. And so but I knew that, and I knew it would work. I knew what the requirements were, and I knew what I could do. So I saw an opportunity that other people did not see because of what was allowed in the zoning. Now fast forward here with even more zoning changes, and goes into trends and future changes, what's going on with zoning now. I didn't know this at the time. I don't think it was even on the agenda, but now I can actually take that, and we're working through the process to partition that, because I built it as a separate structure. You can't even tell driving by that it's on the same lot. And so pretty soon, knock on wood, hope all goes through with the city and the process there. It should, but um, it will be two separate lots, and that's going to create a bunch of extra value. Instead of a single family home with an accessory dwelling unit, I'll have two lots, two separate residences, and it will create a lot more value. So what is coming down as far as changes that potentially could create more value? There's been a lot of that happening in Oregon and in some of the local jurisdictions here, where you can increase density further than what you could before. You can do two ADUs in some areas. You can do 4 units in areas where you can only do, single family home before. You can do there's just a lot more density, cottage clusters, things like that, right? Lots smaller lots than which is how we're able to do this partition with the ADU, smaller lots than what we're allowed before. Just lots of nuances that can create value if you know what's going on in zoning. So check the zoning. What can you do? What can you not do? What are the limitations? Are you going to be able to do what you want to do? And what are some possibilities in the future? Because maybe there's not a great opportunity now, but maybe there's something that's in the process that looks pretty solid, that it's going to move forward, and it's going to create a ton of value. Maybe they're rezoning something, moving the line for zoning, just overall changes. A lot of the stuff here in Oregon's been on the state level that the local jurisdictions have had to adopt. So all of that you need to pay attention to and check when you're looking at a specific property. Now, again, depending on the deal that you're looking at, this may or may not apply. Probably want to just glance at it just to know what's going on. But if you're buying a home in a tract development where every house is pretty much, there's 3 versions and it's built in, the 90s or 2000s or something like that, probably not a lot going on there that's really going to affect anything. But not a bad thing to check out just to make sure, just in case, just you don't want to miss anything. Um, Now so the flip side of the trends is you also want to make sure it's not going to be something detrimental to your plan. And I say, I don't want to say detrimental overall, because that's subjective. That's depends on what you're trying to do. Everybody has a different take on, if something's good or bad zoning wise, changes, things like that, right? Depending on their perspective, their business plan, all of that. But there were some changes made within Portland, where before they would measure based on lot coverage. So, and if a zoning allowed 50% lot coverage, you could cover 50% of the lot. 5,000 square foot lot, I can cover 2,500 square foot of the lot with impermeable surface, driveways, patios, and the building itself. So, that footprint of the building was important based from that. Now they have changed that to a floor area ratio, meaning the square footage of, now this is a very simplistic version, just FYI, there's way more nuances to it than this in zoning. So, but it's a great example. They changed it to floor area ratio, meaning now it's, instead of 50% of the lot, say, that you can cover, it's 50% of the lot. That's how much square footage you can build. Now, that changes things drastically, right? If you were an infill builder building, buying these little bungalows and tearing them down, and you've got a 5,000 square foot lot, I can cover 2,500 square feet of that. I can do a pretty large footprint. I can potentially do a 3-story house. I could build a 4,000 square foot house, where there was an 800 square foot bungalow before. I can create a lot of value there, right? Well, now that same lot, I might only be able to build a 2,500 square foot house. Maybe still some upside, but totally messes with your business model if that's what you're used to doing, right? And it changes your numbers and what you can get for the final product, right? So, um, need to know where those trends are headed, because you don't want to build up an inventory of development properties where you're penciling it one way and then something changes that you're not aware of, and now you can't do what you wanted to do. Okay, so that is all, zoning, what's happening there, overall condition of the property, property history, permitting, checking the title, all of that stuff. That's all, definitely want to check those things out. Now, that's specific to the property itself, right? Okay, what about what's around the property? Um, what are the surroundings like? What's around it that may be odd, maybe hard for people to overlook, maybe a turnoff for a potential tenant or buyer, right? Noise pollution, smells, police or fire station, great to have nearby, right? In case of an emergency, maybe not right across the street where every time they, tear out to go to a fire, that you're hearing their, um, horns blaring and everything, right? So, um, uh, ballparks, right? baseball fields, football fields, again, not necessarily bad, but maybe you don't want to hear them every Saturday out there, yelling and screaming, or at night games, and those lights, those are bright lights on those fields, right? And could be glaring right in your backyard. So just things that you may not notice, especially like in the light of day, right? Oh, there's a school back there. That's great. Well, yeah, they're turn on their lights. It gets dark at 6 o'clock. They turn on their field lights and they're blaring till 10:30, 11 o'clock at night. That may not be fun. So just pay attention to your surroundings, what's going on there, neighbors, right? Um, even even if you are willing, maybe there's a neighboring property that's really not in very good shape either. You're buying something, you're going to fix it up and sell it. The neighbor's property is not great either. Um, you could literally pencil in and say, you know what, I'm gonna $10,000 of my budget is I'm gonna clean up the neighbor's yard and help them paint their house, and I'm gonna make that look nice too. And yeah, it's I'm not really getting a return on it per se, but I am, because I'm making the neighbor property look better than it does, and it's going to detract from my being able to sell this property. Well, they may not want that, believe it or not, right? So they may be just fine with it. People are weird sometimes. People have different perspectives, and so just don't assume that because if someone, we talk about this in a lot of different situations. Just because you would do something doesn't mean someone else would, right? So don't assume that because someone knocked on your door and your house needed to be painted and they offered to paint it for you for free, that someone else would say yes to that as well. They may not, right? It's just, you gotta, if that's part of your plan, address it up front, right? Knock on the door before you close on it. Let them know, hey, I'd be happy to spend some money on your house. Would you have a problem with me? I mean, it seems like a silly question, right? Would you have a problem with me spending some of my own money to clean up your house? You would think the answer would be yes, but not always. So again, what are some things around you what are things that you can take care of, that you can handle, that you can fix, and what are some things that you can't do anything about? And make sure you factor that in. How is the market going to perceive those things, and is it going to be something that's going to be too detrimental to overcome, or just become a huge headache, and turn off a lot of buyers, right? So you got to factor all that stuff in. Okay, let's branch out even a little bit more. You got to look at the market, right? The market. So we've kind of gone property, surrounding, and neighborhoods. Now we're going a little bit bigger, market, and what is going on in the overall market. And again, when we talk about the market, we talk about the macro level. We also talk about, the local level, state and city, and then even down to, the neighborhood and the street. So what is going on in the market? What is going on with, check your sales comps or your rental comps, depending on what your strategy is. Uh, what are the trends? Are they trending up or down? What are the different sectors in pricing? Because you're, again, anything data is just all lumped into one category. I mean, you can break it out, but generally, you look at Portland Metro market action reports, average days on market. That doesn't mean anything. Okay, that's everything from your $300,000 condo up to your 2 million or $3 million home up on acreage up on the hill, all lumped into one thing. What's the average days on market? It doesn't really tell you anything. I mean, other than a trend, from what it was last month or last year, overall. But you could have one sector, and you do have one sector of the market moving at, maybe it's 14 days on market. And then you could have another sector, and you often do have other sectors that are, maybe they're 2 or 3 months on the market or more, right? So, um, is the sector that of the property that you're buying and what you're looking to do, what is that sector doing? Is it selling quickly, or is it going to be on the market longer if you're reselling it? Same thing with rents, right? If you're a class A, apartment building, you're going to be in a different spot in the market than maybe your class C, right? They're not they're not the same market, so you have to look at those segments and really look at what's moving. And again, it's to know, right? It doesn't mean don't do the deal necessarily. It's just, okay, well, the average days on market's 25. This sector of the market's taking, 75 days to get an offer and sell. So you factor that in, right? So but if you're expecting an offer in 2 weeks and really that sector of the market's 2.5 months, that could really hurt you if you don't know that going into it. Um, Again, what's the market temperature? What's the activity? What's moving? What's not moving? Because there could be pieces of the market that are really just kind of sitting there. And we definitely see this right now with where interest rates are at and just certain sectors in the market are still moving pretty good, and some are just kind of sitting there for a little bit longer. It's not that they're not selling; they're just taking longer, and they're taking a little bit more of a hit. Um, so again, knowing those things super important. Your local market strength. What does your local market look like that you're investing in? We talk about this a lot when analyzing a market. Migration, jobs. How strong is the market that you're in, so that you can again factor that in. Um, and just know that it's not that it necessarily can't be trending down. I mean, people buy in down markets all the time, right? In markets that are trending down, you just have to know that so you can properly analyze the deal, right? So where's your market headed? Where's it likely to go? What are price and rent um, um, forecasts looking like? All of those things. Okay, financing terms. This is something that I think a lot of people they don't really think about when they're analyzing a deal. Uh, in this, where's finance headed? What are the trends in finance? And we've seen this be a big factor right now as interest rates have adjusted so much over the last couple of years. Right, a lot of people were underwriting, conservatively, quote unquote, that maybe they were getting into a deal at 4%, 4.5%, and they were, well, what if, rates are probably going to trend up? Let's pencil it at a refinance of 5.5% here in a year and a half. And here we are at 7.5, 8%, and the deal doesn't work so well anymore, right? So that nobody, I think, saw that coming. Nobody saw that quick of a change, that much of a change that quickly. So there's only so much you can do there. Even if people were being conservative, I think they couldn't foresee where we were going to be here when we were in that 3.5, 4% interest rate environment. But it's still something to look at, right? What are the trends? Where are we heading? Are we, at least they were probably hopefully underwriting it with a higher interest rate and not a lower interest rate, because we were not, we're already at the lowest we probably possibly could be. So hopefully they were doing that, right? So okay, it's likely to trend up. So this is my, I'm going to refinance in 2 years. Here's what that's going to look like, and penciling it that way. Also, part of that is knowing if lending is going to tighten, what is that going to do? Like if you feel like lending might tighten or loosen, that could change not only interest rates, but it could change your buyer pool, how many people are out there. It could change what types of products that lenders are willing to lend on, right? I mean, for a long time, buyers and I think also underwriters and appraisers were overlooking property condition to some degree, versus being a little bit more picky when they get in a more conservative environment. So that's something to be aware of. Manufactured homes are something that a lot of times when lending starts tightening up, and I'm not talking about home only, I'm talking about manufactured home on its own lot, affixed to the land, title wise, and all that. So it's part of the real property. But the nuances are different, and that could be something where lenders feel like that's a little bit higher risk, and so they might pull back or make it harder to qualify for, or just even stop doing some loans like that if they feel like they're a higher risk. So just all things to what's the product you're buying, what kind of financing is available, what type of financing will likely be available when you go to sell or refinance or whatever your exit strategy is. So very important to look at that as well. And then the all-encompassing, will your strategy work? Okay, this seems like a dumb question, but uh, you can go into a property and say, I'm going to flip this property, and you can still, it can still not work. If you're so blinded by, your strategy, uh, you may not even question, will this work? Will this work in this neighborhood? Will this work in this market? Right. And it seems dumb, but it's actually really important to think about. And especially if you're getting into like a market that maybe you don't, or a neighborhood you don't know very well, uh, you should learn it. You should know the nuances of it, and is it renters or owners, all of those things, right? Because you could want to flip a property in a neighborhood that is mainly renters, and people just don't buy in that neighborhood for whatever reason. There's markets like that. There's neighborhoods like that, and so if your strategy is to flip, you may be putting yourself in a spot where um, that's not the best strategy. So questioning if your strategy that you have, will it work, and then what's your plan B? Even if your plan A does seem viable, what is your plan B? Because you need a plan B, um, because you may not be able to pull off your plan A. Market may change, money may get tight, things may shift in what you're needing on your end, and so you may have to pivot to plan B. So always have at least a plan A and a plan B, if not more. Know what else could work. Have it work more than one way, if at all possible. And then, man, way more than I can cover on here. But when you step into commercial, multifamily, a whole slew of other things that you need to look at, along with most of these other prior things. If I suppose probably all of the prior things, um, you know, reviewing leases. What are the current leases? What are the terms of the leases? What's written in for increases? Is that a good or bad thing? If there, how is it not enough? Is it too much? Is it, are there did did they sneak in a couple last minute tenants with high to make it look like they had high market rents in there, the high peak of the market rents, but really there's a whole bunch of incentives written in there that offset that. Not that any landlord would do that, right? Just all the nuances of that. You gotta really get into the weeds on some of that stuff, to make sure you're not getting something pull over on you. Make sure that you understand what you're buying. Make sure that, oh, those rents that seem a little bit higher than market, how do they get those? But they have leases and they're performing well. Okay, but what? But how? Why? What's underneath that? Is it legit, or is there something hidden in there that maybe you're not seeing? Doing checking with the tenants, verifying leases, verifying that that's what they're paying, verifying that they're caught up. All these things are things that you want to do, right? So, um, checking expenses, checking financials, um, checking not just what current expenses are, but what are your likely expenses. Insurance has gone up a bunch. Taxes will change a lot of times, especially at the time of a sale. So if you're penciling based on the expenses that they have, but then your insurance goes up 40% and taxes go up 40%, your entire investment changes, right? So verifying that those are not going to change, and if they are, that about it, and you're factoring that in. What's on their financials and what's not on their financials, and this could be you know both a red flag or it could be an opportunity, right? So you know digging into financials is where you can find uncover some things that are questionable, but you also find some opportunity there, right? Especially as you look at a lot of deals. There, and if someone's not looking at the financials properly, right, they may look at just the bottom line and say the net operating income on here doesn't make any sense. Uh, this is way lower than it should be. I don't understand this. Then this deal doesn't work, and they just may move on. Well, what if the owner's paying themselves a large salary out of that, right, to manage the property? That happens, right? For tax reasons, they may be doing that, right? Well, that may be way more than what you pay a property manager. Maybe they don't have anything at all like that, and the net operating income looks okay, but then you look at it and there is no line item in there for property management, and so that's gonna be an expense to you. It should be, because you should be hiring a property manager. And so you need to factor that in, and there should be, even if they're self-managing, there should be a number in there. But a lot of, mom and pop ownership, they don't do that. Um, what are the utilities like? Can you fix that? Can you solve it? Can you cut down on that? Can you bill back to tenants? Right? Those are opportunities to reduce expenses, increase your NOI and value. You're looking for the challenges, you're looking for discrepancies, you're looking for opportunities within those numbers. So that's a huge one for commercial, is looking at that. And then again, that's all with specifically what's going on with that product type in the market. What is supply and demand like? What's the market like in the area? Inventory levels, all of those things that we talked about that go with single family or development, all of those. So that's a lot, but again, there is a lot more to be looking at. Environmental aspects, just there's so many different things that you want to be having your eyes on when you are looking at a property. And again, depends on what type of property and how many nuances there are to it. Single family home, quick flip versus a development property versus commercial are not the same as far as what you're looking at, of course. But the bottom line is, don't skimp on your due diligence. Um, I know this. I know this from experience, and it didn't work very well. You skimp on due diligence, you may end up okay. You may be fortunate, and you may luck out, but you're adding a lot of risk. There's risk in investment anyway. Don't add to the risk by being lazy on your research, being lazy on your due diligence. Know your product, know your niche, know your market, know your strategy. Do the digging to make sure you're not missing something. You could still miss something, but don't have it be because uh, you were lazy, or because you were not paying attention, or just not really doing your underwriting the way that you should be doing it. Don't have it be because you just didn't care enough to check. That's a bad reason to lose money or make a mistake. If you miss something, that's how we learn. Okay, you don't see something, you miss. You know what? Now I know next time to check that out too. But don't have it be because you just didn't take the time to do it. So don't skip on your due diligence. Hopefully this has been helpful to you. Hopefully you've added some things to your list for when you're looking at a deal, and making sure that you're buying something that makes sense, and making sure that you're taking less risk by checking all these things out in advance. So thanks again for listening. Hopefully this has been helpful to you. Go out there, find some great deals, do some really good due diligence, and buy some amazing investment properties.